Hi, I'm Renee Curtis, a financial advisor and certified financial planner. I have been in the industry for over 7 years, and during that time, I have had several real estate agents as my clients. I'm here today to help you track your profit and learn how to plan for financial success. It is no secret that self-employed individuals are faced with a different set of challenges than others, and realtors are no exception. As the owner of your own business, it is your responsibility to take control of your finances from the business side and the personal side. Let's start with the business side of things. Tracking your profit and loss is an essential part of running a business. Simply put, it shows whether your business is making money or not. The formula for a P&L statement is pretty straightforward. Start with your gross income. This would be your commissions, any W-2 income you have, and any additional revenue you would receive that month. Subtract out the cost of goods sold. This would be any expenses directly related to your services, such as commission splits, brokerage fees, photographers paid per house, special signage or staging for a house, client gifts, etc. These are expenses that wouldn't exist if you had no transactions for the month. This equals your gross profit for the month. Next, you subtract out operating expenses and other expenses. Operating expenses are expenses you can expect regardless of the number of transactions you have that month. This would be general marketing materials, rent, CPA fees, dues, meals, and cell phone bill. Other expenses would be taxes and insurance. This gives you your net profit. Breaking down your income and expenses in this way can help you determine if there are other areas that you can save money. Other suggestions to run more like a business include making sure that you're setting aside money for taxes. I suggest working with a tax professional who is familiar with real estate agents. Make sure you fully understand your commission structure. This may seem like a no-brainer, but it isn't always straightforward and can vary at earning levels. Have a good understanding of this can help you keep track of your goals and will allow you to more accurately project what you have in the works. Establish a separate account for your business. This helps you keep your business income and expenses separate from your personal. It also makes things cleaner from an accounting perspective, and this will make your life much easier when tax season rolls around, and it makes it easier to track your P&L. Pay yourself like an employee. If you are struggling with inconsistent cash flow, pay yourself a set dollar amount each month. Say you've determined that you need $5,000 a month for your expenses. Set up your business account to move $5,000 a month to your personal account. Some months you may make $7,000, other months you may make $3,000, but this method allows your personal cash flow to feel more stable. In order to do this successfully, you will need to build up a cash cushion in your business account. Look into your options for certain benefits that would typically be provided by a standard employer, such as health insurance, life insurance, and retirement accounts. Now let's look at things from the personal side. Just like it is important to understand your cash flow from a business perspective, it is just as important to understand your cash flow from a personal standpoint. I would suggest establishing a simple budget. Many people don't love the idea of using a traditional budget because it insinuates that you have to be a tight spender. I would encourage that you use a budget more in a way that helps you to understand your inflows, outflows, and fixed expenses. If you know these numbers, then it is much easier to flex your spending when income is consistent and when you're trying to plan for bigger expenses. A simple budget formula that you can use would be to start with your net income. It is okay if you have to use an estimated number for the month. If you are estimating, I would start with a conservative number and adjust. This is where tracking your P&L and understanding your business cash flow really comes in handy. Next, subtract out your fixed expenses and non-negotiables. Fixed expenses would be rent, mortgage payments, car payment, utility, or other debt payments. Non-negotiables would be expenses for groceries, pet care, or basic personal care. These are expenses that may fluctuate month to month, but are required to meet basic needs. This gives you what I like to call your flex money. Knowing this number allows you to track where you are throughout the month without having to budget for specifics. Next, you subtract out expenses that differ month to month. In a way, you are allocating how you anticipate spending your flex money for the upcoming month. I like to look at my calendar to see what I have coming up. I may need to allocate extra money for travel, gifts, or shopping. There are some expenses that you may choose to keep consistent, such as allocating money for eating out each month. Finally, you will have a surplus or a deficit for the month. If you have a surplus, you may decide to add more to savings pay additional debts, or set that money aside for upcoming expenses. If you consistently have a deficit each month, that means you need to reevaluate your flex spending category and decide where you can cut back. I find this to be a loose way to track spending while still maintaining control over your cash flow. Bucketing your income can also be an easy way to make sure you have adequate cash set aside. Some buckets I think worth adding to your budget are emergency fund. Typically, this is about 6 months worth of living expenses depending on your personal situation. This will not only help in emergencies, but can help bridge the income gap during slower months. Retirement fund. Typically, realtors don't have the benefit of a retirement plan being offered to them. You have to be proactive about saving money for retirement. Don't forget that pre-tax contributions can help lower your taxable income. When it comes to retirement, the earlier you can start, the better. Automating this from the beginning is a good habit to get into. Vacation funds. Since your income can fluctuate, it would be helpful to set aside a specific amount each month. This gives you more flexibility when it comes to planning and spending money on vacation. Healthcare funds. It's not a bad idea to set aside money in case of a healthcare emergency. This is a particularly good idea if you are able to take advantage of tax-friendly accounts such as a health savings account, aka an HSA. Oftentimes, people aren't sure where to start when it comes to knowing how much money you should be spending and saving. A good place to start when building your budget and bucketing your income is the 50-30-20 rule. 50% of your income goes towards must-haves like grocery, rent, or car insurance. These are expenses that you can't and shouldn't live without. 30% of your income goes towards discretionary spending like entertainment or shopping. 20% of your income goes towards saving or extra debt payments. This isn't a one-size-fits-all approach, but gives a good starting point that you can tweak when you become more comfortable with your cash flow. Finally, I would suggest automating as much as possible. Setting up your accounts to automatically move money into different buckets is efficient and holds you more accountable to your goals. I believe running your practice as a business will help you to be a more successful real estate agent, and in order to do this, you need to be organized, disciplined, and understand your cash flow. The day-to-day can get hectic for realtors, but don't forget to take time to set goals, track your progress, and prepare for your future.